crypto, the ETH merge, ETH yields, why it all matters. But the point being is macro is the driver of everything. It's a bit longer and then move higher. Don't know. I imagine if growth implodes, the dollar moves. The dollar is already pricing ISM around 45, so it's already pricing a full recession, but I think it's going to be bigger than that. So I think the rate of change in the dollar goes further. So that's still a wrecking ball, still to keep playing out over time. I think there's still washouts to come from the energy sector and others. Doesn't mean we go all the way back to the pre-COVID levels where many of the markets have got to, but we're going to retrace a lot more of that. My base case is that oil comes down somewhere between $80 and $60, to $80 and $60. The equity markets are somewhat more complicated because they're already pricing in. The S&P is pricing in ISM around 45, so there's a bit more room. The NASDAQ is around about 40, so it's pretty much priced in what I think is coming. My forward-looking indicators, which I'll show in a minute, will suggest that the bottom of the economic trough is like March next year. But I think stocks bottom first. So in 2018, they bottomed a year before the economy. In 1974, these are the parallels I've been using. It bottomed 3 months before. So it's somewhere between that. So I think they bottom in the next few months, or they have bottomed, which is contrary to what most people think. If they price in the ISM properly, there should be another leg lower, and that should be the final leg for me. So that's what I'm looking at. Now, corroborating evidence is that crypto started going up, and many of these tokens have risen 100% in a week and a half or 2 weeks. Now, they broke these patterns where everybody was expecting another leg lower, much like they are in equities, which makes me slightly suspicious of equities, which I don't like being short. But crypto did really well. It's now overbought. We're putting in like DMARC 9 patterns, which tend to be a short-term correction. Now, do we go back to retest the lows based on the growth numbers and other stuff? I don't think so. I think we're more sideways consolidation than another rip higher, but it's not clear to me. But I think the base is in, and I've been saying that for a while now, because crypto is a very forward-looking asset, and it will look further ahead than anybody else, and it's sniffing out the change in bond yields. So that brings me on to the most important part, which is bond yields. Bond yields are now rolling over. As I've been forecasting, they're about to break a head and shoulders top pattern. So Brian, if you can show the head and shoulders top pattern, which is this chart here, 275 in 10-year bond yields. If it breaks that, then we should start to go down below 2%. I think somewhere around 175. So that's not what the market expects. But if you think of what that does to growthy assets, it's taking down the future discount rate. And if that means that inflation is coming lower, then you're taking some of the inflation expectations out. So things like what I refer to as the exponential age stocks, the further out the growth curve, things like Scottish Mutual Trust in the UK, which I've just interviewed on Real Vision. They're amazing, some of the best tech investors in the world. They're going to be coming on, but also, you know, whether it's the semiconductors, whether it's ARC, whether it's robotics, and all of this that I've got a whole basket of, these should start to stabilize and do okay. And we're starting to see that now, but it's still early days because they will be slightly behind crypto in terms of forward looking. So we're at this massive shift where inflation goes, growth goes, and bond yields start to fall. So Brian, if you can show the chart of the GMI kind of financial indicator. So this is the financial conditions index that we put together. Pleased to announce Julian Bittle, who many people know has joined Global Macro Investor as my head of macro research, and he put this chart together. And so what this shows is that financial conditions, this is the rate of change of the dollar, rate of change of yields, and rate of change of commodities, are showing a massive decline in growth. And it leads ISM by 9 months, which tells us that in 9 months' time, ISM will have bottomed because it's already ticking up. So when we map assets across them, and if anybody goes to my Twitter feed today, you'll see that all assets correlate to ISM except crypto, which I'll come on to. So they all correlate. It's all macro. It's all about the business cycle. If you don't understand that, then it's really difficult to navigate yourself around this world because you're flying blind. But when you look at it, this chart, what it's saying is bonds are the most mispriced of all assets. They're actually pricing the ISM at 65, which is not where it is today. It's in the mid-50s, or mid to low 50s. Then it's high yield spreads, then it's small caps, then it's cyclicals. They're all kind of roughly in line with ISM, so these could move lower. S&P 500, as I said, is leading the ISM. It's at 45. The NASDAQ is getting down to 40, and that GMI exponential age basket is already pricing ISM at 35. It's massively discounted. So what does a chart like that tells you is that you should be looking to acquire the long end of growth if you think inflation is going to be less of a concern and rates aren't going to be as high. So our job is to live 12 to 18 months in the future. 12 to 18 months, we should have had a recession. Rates should have come lower. Inflation should be lower. Therefore, these stocks should be higher. That's kind of how you need to think about macro. And bonds, well, if they're not pricing in the recession right now, then they give us a gift of an opportunity, which is the buy bonds, wear diamonds theme, where bond yields have lagged where the economic indicators are because of the reallocation out of bonds because of inflation fears that's happened massively. So I think that readjusts and people panic back into bonds. Finally, crypto. So if you bring up the final chart, Brian, crypto isn't driven by the business cycle, but it's driven by global liquidity. So this is the global M2 deviation from trend. So it's the rate of change of M2 and how far it is away from trend. And it's about 1.5 standard deviations away from trend, and it's turning higher. That time it ever happens, both at the top and the bottom, leads to the turn in the crypto markets because liquidity drives crypto. Remember, this is not a cyclical asset, so it doesn't go back to where it was like oil and commodities. It's a network adoption model that goes up and to the right over time with these big volatile bands. Now, a lot of people had the narrative that this was driven by the halving. Now, maybe the halving, which is a reduction of supply every 4 years in Bitcoin, is a factor because it's correlated with liquidity. So what you're doing, you put more liquidity into the markets, it leads to more people able to allocate capital into a low supply environment, which is the halving. You don't need the halving as a necessary precursor. Ethereum's about to have a triple halving event. I'm going to do a whole update over the weekend. I'm going to film for Real Vision members about all of this. The macro, crypto, the ETH merge, ETH yields, why it all matters. But the point being is macro is the driver of everything. And once you understand that, you understand where the world should be going. Is using the global economy as a forecast for asset prices. And you're looking for dislocations, mispricings, or opportunities based on that. So normally how we look about this is the business cycle. The business cycle is the ups and downs of GDP that economists never forecast because they use linear models. But once you understand that the economy is cyclical, you understand, okay, it's forecastable because usually when it rolls over from a peak, it goes to a trough, which is a recession. After a recession, you go to recovery. That cycle, you can show a 3-year-old kid and they go, oh yeah, well, the economy goes up and down. You ask an economist at the Fed and they say it's linear, as do all economists. It's crazy. It's crazy that people don't model this, which is why macro-based investors tend to use the business cycle because it gives us an edge. And why all economists tend to be very wrong at turning points and these acceleration points, but tend to be right over a longer term time horizon when you look at averages. So when you start using these, you realize that it actually drives all asset prices. So the year-on-year rate of change of copper, oil, gold, equities, credit, emerging markets, bonds, everything is basically related to the business cycle, which is global supply and demand. So once you understand how to use the business cycle and what it is, and then how to look at asset prices against it, it like opens up this magical mystery world that is so confusing until you do this. And once you do this, you're like, oh, I get it now. It's all I see from all the comments, people just don't understand. They know it's important, but they don't even know how to think about all of this. Not just what is macro, but how to invest, how to think about building portfolios, how to think about risk. What is technical analysis? What the hell is Raoul talking about when he talks about DMARC indicators? What do those numbers mean? What does any of this mean? Right, I get it's important. I know it's my future. It's my financial future. My vision of myself is based on how well I can invest the capital that I've got or protect it. But I don't understand, right? That is so common and it's normal. It's okay. We've all been there.